Conversations. I am Neeraj Shah, and our guest today is Russell Napier. Remember, the Asian financial crisis, 1995 to 1998, charts his personal journey during the crisis as he wrote daily for institutional investors about an increasingly uncertain future. And the book charts the mistakes and successes of investors in the battle for investment survival in Asia from 1995 to 1998. And trust me, it was a difficult time. So we'll try and talk to him about some lessons from that crisis for EM investors in light of the current conditions and the repression, as he calls it. Russell, so good having you. Thanks so much for joining in. I hope all is safe, and congratulations in advance on the success of the book. I'm preemptive, but I'm sure it'll be successful.
Thank you. Thank you very much. You've got more faith than I have.
No, okay, Russell. So let's try and do that, because I think it will be relevant for a lot of people, not just back here in India, but across the world, to try and understand about one. Let's start off with, why did you write the book in the post-COVID world? Is there a timing element to this book, the content, and the current world that we're living in?
Well, it's a period I hadn't revisited. I'd lived through it, and I thought, obviously, having lived through it, I knew all the lessons. I then began to write a much longer book, looking at everything I'd written. But I found so much material in just the Asian economic crisis that I thought it was worth bringing it up again. And of course, the crucial thing is, to me anyway, the crucial thing is this period was all about managed exchange rate regimes and how they are really very different from floating exchange rate regimes. I mean, for investors, I mean, for equity investors, for bond investors. And I still feel that that lesson has not been learned. That people who, particularly people who come from the West and go to India or China, kind of use the same analytical tools as they would if they were managing money in the US. And I think that's the lesson of the Asian financial crisis, that when a managed exchange rate is in place, and India has one, I mean, you can see that by the rapid rise in its foreign exchange reserves, that we need to think along different lines and different rules. So in reading the material, I thought, well, actually, we didn't learn these lessons from this particular episode. So this is a book. This is not a chapter. This is a whole book. And the other thing, it had lots of very good data in it on, bottom-up micro data on valuations. And, one of the things I find frustrating as a financial historian is when I'm reading financial history, there's no reference to the price-to-book ratios or the PE ratios or whatever. And everybody who's watching this will know that price is what you pay and value is what you get, to quote Mr. Buffett. So I thought it was important to focus on the shift in values during that period as well. So that's why the book is written. The timing, because it's 25 years since I started writing, which is, but the timing really is, once again, we are ignoring some of the lessons that apply only to manage, or in extremis, I think, in particular in managed exchange rate regimes.
Okay. Yeah, I'll probe some of the points that you made in this answer, but let me start off with a couple of points that I've prepared and which I wanted to ask you. Now, that crisis, which started in Thailand, came largely as a surprise to market participants. And I think I read you quote this somewhere, that while whatever happened in the US dollar value of the asset markets declining by maybe 90% or thereabouts, it would be wrong to say that there were no warning signs. So why is it that nobody saw it coming? Because as you said in one of the interactions on a podcast, it's not that those people were less smart or more stupid than the current generation of money managers, or we are.
Absolutely right. Niraj, that's the question the Queen of England asked as well about the last crisis. Why did nobody see it coming? And I mean, there's a long answer on that, which is to do with incentives. If the incentives are wrong, and if the incentives are too short term, it's very easy to ignore some very big warning signals. So there's an issue of incentives, which is not something I do particularly cover in the book. In terms of, you like, the fundamentals, it was really very easy. People saw that the price earnings ratio was steadily going down. So we had this great rise in markets up until the end of 93, and the earnings continued to come through, and basically the stock markets were going sideways. So people were looking at the historical range of the price earnings ratio, and they were saying, well, look, they're getting cheaper and cheaper and cheaper. Why wouldn't we want to buy these things that are getting cheaper and cheaper and cheaper? Now, the work I was writing then and is in this book was saying, look, this earnings that you're looking at, a lot of which were coming in banking, a lot of which were coming in property, these are a product of a monetary and credit system which is entirely driven by the external accounts and currency management regimes. And those earnings are entirely illusory. They're not real earnings if this thing starts to go in the wrong direction and if interest rates start to rise. So one of the fundamental things is that people were looking at that. And it's really fascinating to look back, because this obviously is the same time when the internet boom is beginning. It's 1995 that Netflix is listed, which is really fires the starting gun for this. And there was huge skepticism about this, and it was supposed to be all nonsense, and the internet was just a joke. But you could see Netflix trading on an infinite PE, and you could see Asian stocks maybe trading on 15 times when they'd been on 19 times. And that illusion of valuation was a key driver for this. But that's really what the book is about, why that was an illusion in a managed exchange rate regime. So yeah, absolutely. I keep saying over and over again, no one believes me. You know, it is smart people who make stupid decisions. And this book and my last book is looking at why smart people make stupid decisions. So beyond incentives, that was the reason why people were. It was a valuation. It turned out to be a great value trap, probably the biggest value trap of all time, because people didn't understand how fragile the earnings actually were.
And you kind of get a feeling that some of those things are evident in different forms, but currently evident around us in the current times as well?
Yeah, a little bit. I mean, I think you have to be more focused. Remember, this was a period when Asia was running huge current account deficits, which had to be funded. And that's not really where we are today. So, I mean, there's a really strong fundamental improvement in this. You'll also know that foreign exchange reserves are so much bigger than they were then. But the one I want to focus on is really China more than India and North Asia in 95, 1998. So as this crisis began, remember it begins on the 2nd of July, 1997. It rages really strongly, but it has no impact in North Asia, by which I would mean particularly Taiwan and Korea, until October. Now that may seem like a short period of time, but when you're a market participant, that's a very long period of time, and nobody realized what was going to happen in North Asia. And for those who don't know the story, it's in the book. Korea is really bankrupt by Christmas of that year. So that's October to Christmas. I mean, that's pretty dramatic stuff. But the reason that we didn't really worry about these things is these countries had current account surpluses, and they had some of the biggest foreign exchange reserves in the world. And looking at them, they looked almost like fortresses. But it turned out that the weakness was as follows. The local corporates were highly geared, and also there were enough foreigners in there that when their money was pulled out, they pushed interest rates higher. So I can go through the mechanism if you like, but if you want to defend your exchange rate at a time when capital is exiting, then ultimately it means tighter liquidity. And it turned out that the domestic corporates in particular were so fragile with gearing that as this capital withdrew, this foreign capital withdrew, even though they had current account surpluses, even though they had very large foreign exchange reserves, the rise in interest rates was enough to create quite a lot of chaos. And the authorities decided that that was just too much, and they stepped away from their exchange rates. So the great shock of the crisis was not that Thailand devalued, because by the time it came, I think on the balance of probabilities, most people expected it. It was that Korea and Taiwan were forced to follow suit. So obviously I'm looking at that in a Chinese context, and it looks like a fortress balance sheet in Japan, doesn't it? Or China. You've got your current account surplus, you've got these huge reserves, but ultimately if capital goes the wrong way, it can start putting interest rates up, and that's the key question. Do the local authorities accept interest rates being dictated to them, or do they prefer moving to a more flexible exchange rate where they determine their own interest rates? So I'm pointing the finger at China and saying, you know, this is not the Asian crisis. It's not that they're being forced to do this, but it could illustrate to the Chinese that they've opened their accounts wide enough that foreigners play a role in interest rate determination, and they may want to step away from that. And stepping away from that in a Chinese context means a more flexible exchange rate.
Okay, if I can just draw and try and focus a bit on, the parallels, if you will, to say an economy like India as well, and just trying, and of course the broader EM pact, Russell, but India as well specifically, the belief that some people have is that while we may be in a period of repression, and the West could probably afford it because of the nature of the economies and the balance sheets that they have, simply because economies like India, some of the other Asian economies are economies which need foreign funding and capital flows, they may not be able to afford it. And if they continue this policy of repression, it will eventually have a run on the currency. How do you see that? I mean, what are your thoughts there? And how do you see that in the context of what had happened back then in 97 as well?
Yeah, so the repression, I think when I try to explain it to anybody in the world what repression is, it ultimately takes you to a kind of licensed Raj situation, which everybody in India will be very familiar with, But funnily enough, you're more familiar with repression than the British are, the Americans are, the French are, because you had to suffer it more recently. So Indians intuitively grasp what that system is like. But we have to go back to why you would choose that policy. Now, my opinion, and it may be wrong, is that India will not choose it. The reason that you choose a policy of repression is because you've got far much debt relative to GDP, and you need to create a system where interest rates stay permanently lower than inflation. And that may sound fairly innocuous, but actually to get to that, you do have to you inevitably end up with a sort of license Raj situation. India doesn't have that much debt. I mean, its debt to GDP ratio is one of the lower in the world, certainly way below the developed world, and even by an emerging markets standards, it's fairly low. So my first position would be this. Every developed world country has to do financial repression, but India doesn't. And actually, there are very few emerging markets, apart from China, who do have to do financial repression. So the question is, if the West gets into financial repression, what is going to be the impact on India? That's the key thing. That's what we're really talking about. So where I would be mistaken is if India itself goes for repression, in which case I'd have to revise all my opinions. But if it doesn't, and the West does, then I think obviously you're going to get higher inflation. That's just a fact. I mean, if the whole developed world is generating inflation, it is inevitable that India will get somewhat higher inflation, and you have to live with higher inflation. My belief is if you don't believe in repression in India, interest rates are allowed to rise to reflect that higher. So that's not good for asset markets in the short term. That's a normal sort of cyclical situation where inflation is going up and interest rates are going up. But then we have this final caveat. In a world where interest rates are significantly and structurally negative in the West, people will be very keen to put money into India. I mean, the first rule of a financial repression is get your money out of the country. Now, it's funny, when I talk to developed world investors about that, they say, well, where on earth could we put it? We can't put it in Germany, France, United Kingdom, America. And I say, well, what about India? And they sort of laugh. And then you can see a little light bulb going on above their head. And they're thinking, well, wait a minute. It may not be the right answer, but it's something worth investigating here. If you are the only, and it won't just be India, there will be other emerging markets as well who do not do repression, you should be attracting a fairly significant amount of capital. So I know the reason why people are concerned about capital inflows into China, because we might try and restrict those coming out of the developed world. But the market force will be for money to flow from repressed regimes to non-repressed regimes. And as long as policymakers in India step back and stay away from repression, I think India will continue to attract. In fact, one of the problems may be attracting too much capital, at least for the first few years. So that's a very long answer to a very simple question. But really, one of the biggest questions we've all got to ask now is, where will my money not be repressed? And I say India. Not everybody agrees. Most people watching this know more about India than I do, but they will make their own decisions. If India doesn't repress, it could be actually a significant beneficiary of significant capital inflows.
That's my question to you, Russell. I saw a piece or an interview that you'd given, which was converted into a piece for all of us to read on July 14th, wherein you are making a point that you believe that structurally inflation in the West is slated to be higher, maybe not at obnoxious levels, but certainly above 4%. So in light of fact that globally inflation may rise, and in India, maybe buoyed by higher oil prices, other agri prices, and wages as well, which might be on the rise, we might see inflation. Do you reckon that the central bank, which has hitherto sounded fairly benign, so to say, and open to doing things in order to control this whole inflation scare in India, will be forced to hike rates, say, in the next 12 months because of what's happening in the West?
So I think they should, and therefore I think they will. And I think it'll be in great contrast to what's happening. So you've kind of hit the nail on the head here. Imagine a West that doesn't raise interest rates to tackle inflation, but in India that does. You would probably be attracting quite a lot of capital. So that is the very core of the call, that there won't be financial repression, that the Reserve Bank of India will react to inflation the way it did last year, 2 years ago, 3 years ago, 4 years and 5 years ago, where the developed world won't. So it's quite a big call. Anybody who's watching this who has a different opinion will come to very different conclusions to me. But in my opinion, no repression in India, which means the central bank has the relationship between interest rates and inflation that it's had for the last 10, 15 years. That to me is a very, very positive thing for India. Now, if it falls short of that and decides that it's the West, it's some sort of central banking geniuses, and they follow these mistakes, I think, if they follow the mistakes of the West, then all bets are off. But I have some degree of confidence the Reserve Bank of India will plough its own course. This needs a great political backing, of course, as well, because in the West, it'll look like it's a very smart thing to do. Why wouldn't you want negative real interest rates? But if with the right political backing and the right central bank, I think India can tackle inflation. That isn't good for asset markets in the short run. I think we all know that. But look, in the long run, it's just wonderful because we realize that this is an outlier in global markets, a place where the rules that relate inflation to interest rates to asset prices still run the way they used to run. And so there is pain associated with that in the short run, but it's incredibly positive in the long run. If politicians and central bankers have the guts in India to do it, then I think they have the ability to do it. The West doesn't have the ability to do it. There's far, far too much debt. So they're kind of being forced down that path. But I think India has a choice, and it's a wonderful choice to have, and I think can reap huge benefits for India in the long term.
Great. Just drawing the conversation back to some lessons that one can draw from the crisis for EMs at large. Now, I'm just wondering, Russell, I meant to ask you, how tricky is the situation for EMs at large currently, considering that under the cloud of COVID-impaired economies, central bankers / governments have gone ahead paying little regard to fiscal deficits and higher fiscal deficits, and arguably the moves from rating agencies as well. Almost every other central banker that I read about or hear about says that it'll be managed, doesn't matter, rating agencies won't act, and fiscal deficits are moving higher. Is that a risk, or do you believe that is manageable, considering that we're coming out of a COVID situation and economies will pick up sooner rather than later?
Yeah, so I'm not unduly concerned about that. And it depends, once again, it depends where you start with on your debt to GDP ratio. If you are France and you're on, 374% of GDP, then, you've got a problem there if you're still borrowing too much, and even if your economy is growing quite sharply. But if you're an economy below 200% of GDP, which is where India is, then growth can get you out of that mess. This is the crucial thing. There are certain levels of debt to GDP where growth will get you out of it. And of course, we all, we want that to happen as soon as possible, but the economies will rebound extremely quickly. But you don't have to grow at 8, 9, 10% to shift your debt burden if the debt burden is relatively low. So, I think the nice, easy example is Germany post the great financial crisis. And after about 3 years, its debt to GDP ratio began to decline, but it wasn't running excessively high levels of nominal GDP growth, but it just happened to have a debt to GDP ratio below 200. So I'm pretty confident that all of the emerging markets, or nearly all the emerging markets, with their debt to GDP ratios so low, will have a level of nominal GDP growth that means their debt to GDP ratios will start to come down. I'm not confident about that at all for the developed world, because they're starting on much, much higher numbers. So we keep coming back to this debt to GDP ratio, and there's much, much more flexibility for policy. And then the final thing is, if the West is holding its interest rates really low, which I think it will be right across the yield curve, it does give emerging markets this opportunity to borrow at relatively cheap real rates. And that, you combine that with good growth and low debt to GDP ratios, then emerging markets are in a good position. I don't get concerned about fiscal deficit being too big. And that can change very quickly once we get to the other side of this dreadful disease.
Okay, Russell, the other question is the corporate balance sheets, and I'm guessing it might be across the Asian region, but having looked at India, at least the corporate balance sheets are much better. And every company or rather a lot of companies that I speak to in India, and I'm guessing that was probably the scene across the Asian hemisphere as well, everybody's talking about how there are global clients in the West looking at a China plus one strategy, coming to India, and I'm guessing going to the other places. And just a fraction of that investment moving out of China into some of these is resulting in great flows. Now, my question to you is this. You mentioned about how some of the investors in the West are, the light bulb going up and saying that, hey, let's look at India. Do you reckon that this time around, the EM pack and the Asian pack has that China plus one benefit, which could result in flows looking fairly strong over the course of the next 12 to 18 months?
Yes, it's a separate discussion, but there is a very, very big discussion, as important, if not more important, on everything we've discussed so far, which is what are the developed world's long-term relationships with China. And those relationships have clearly soured, and those relationships are already into capital. And we see that in so many ways, whether it's relationship with Huawei, which is a foreign attack on a Chinese corporation, or Ant, which is a Chinese attack on a Chinese corporation, with pushing in the US Congress to try and stop pension funds investing into the China. So this is becoming a capital war. And it is becoming increasingly risky for any developed world investor to invest in China in a capital war, because you can get these tit for tat movements, which means that the returns on your capital in China could be under attack. Even getting a return off capital can be difficult, but there's a risk associated with that, which we simply don't associate with India. I mean, we did associate that with India 40, 50 years ago, but we don't associate it with India today. And I think the contrast will be there and become clearer and clearer. And nearly all other emerging markets will benefit from the fact that China is not getting as large a capital inflow in portfolio assets, but probably more importantly in foreign direct investment. That foreign direct investment will have to look elsewhere. We'll have to look for shorter supply chains. We'll have to look for more robust supply chains. So I think, we talked earlier, if you like, about interest rate arbitrage money coming to India. People, discontented with the level of rates relative to inflation in America, so looking to come to India. But there is another flow, which you highlighted here, which could be FDI, as we begin to construct a world which is less reliant on China. I wouldn't like to forecast what percentage of that India will get, but the point is it will get some of it, and some of it is important for India. India has struggled for a long time, used to struggle to be not attract enough capital. So anything that adds to attracting enough, and perhaps I still stick to the case that likely it's going to attract too much, but the changing China relationship definitely plays into the ability of India to attract more capital.
And maybe other EMs too. Now, Russell, when I started this interview, I thought that you were a bit skeptical about what's happening. I'm pleasantly surprised, and therefore I'm asking this question to you. Back then, in the 1990, in the Asian financial crisis, unless I'm very wrong, you were assessing when the unsustainable credit cycle would end. Now, what about now? What lessons can be, or parallels can be drawn from there to what's happening currently and the impact thereof on EMs? You've spoken about the good part. What about some of the tough measures or tough points?
Okay, but we're talking about the whole globe now, and I said the whole point about this book is divide the world into two bits, which is those bits affected by exchange rate management and those that aren't. So those that aren't, and that is the entire developed world, have got excessive credit cycles. I mean, that's why it's got record high debt to GDP ratios. And the only way to deal with that is high inflation. So that doesn't bring everything to a grinding halt. I mean, this is not a collapse. As long as interest rates aren't allowed to rise to reflect the higher inflation, that is the plan. It's a move towards financial repression. That doesn't mean to say that equities go up forever. What it means is eventually you have to force savings institutions to hold this yield curve down. And when you force the savings institutions to buy this government debt, they sell equities and it comes down. But that's a very different mechanism from the traditional cyclical credit grows, credit collapses. That's not what I think is going to happen in the West at all. It's a much more long-term, insidious negative impact as you force savings institutions to sell equities and buy bonds. But to be clear, none of that necessarily has to happen in the emerging markets. I think it'll be seen as a good thing. Interest rates will rise. Credit will slow. It may not necessarily be good for asset markets and emerging markets in the short run, but it remains a pure system, and that pure system continues to attract capital. So it's not the kind of boom bust scenario. Repression is something very different from boom bust, because boom bust is usually 2 years. This repression that the West is getting is going to last 15 years, because it would take about 15 years to get debt to GDP to a low level. India may have to see sharply higher interest rates to contain inflation. That's a problem for 1.5 to 2 years. But the structure of India remains in a much more attractive basis. So the timeline here is very important, but it's not your classic boom bust, because actually repression is there to stop there being a bust, because they realize the consequences of high interest rates in the West. So it's a more difficult and insidious system. And as I said, your viewers should think of the West slipping into a licensed Raj rather than a 1929, 1932 collapse. And actually, which one is worse? I don't know. I mean, I think we have to ask your viewers which is worse, because I'm not sure that one isn't the licensed Raj scenario isn't worse than the first one. But so that's it's a different opinion. It's not a bust. It's this new structure, which ultimately is probably worse for the economy.
So then, Russell, what should EM investors brace themselves for? What in the current context would worry you tremendously for an EM investor, having looked at both 1997 and even 2007, wherein there were tendencies to overshoot and issues thereof?
Well, in terms of just looking for triggers, I mean, obviously the problem is we've got this excessive debt thing. So now you have to look for triggers. And one trigger would be a flexible Chinese exchange rate. I mean, I've been saying it's going to happen for quite a long time. It hasn't happened yet. It may not happen for 2 years. It might happen in 2 months. But when it happens, the Chinese step away from their exchange rate, so they have a truly genuine, completely independent monetary policy, then I think we all realize it's going to fall. Now, on that day, I think the markets will be incredibly terrified of deflation and of China wreaking havoc upon the world, because one of the things about this, but it gives me a chance to wave it around, of course, now. So, is that one of the great things lying behind the Asian financial crisis was the devaluation of the Chinese currency of '94, and it decimated. There's lots of ways I go in the book through the book how it decimated the Asian financial markets. It took a while, but it happened. But anyway, that's one lesson from the Asian financial crisis. I think that people would instantly jump on. Oh my goodness, the Chinese currency is falling, incredibly bad for emerging markets. And I'm sure we would see a major slump in Indian equities and all emerging market equities. Now, in my opinion, that would be a wonderful buying opportunity. This isn't going to bring deflation because China's too big an economy today. It wouldn't be allowed to export all these cheap products and undermine Indian manufacturers. And ultimately, it's doing this to print more money and have higher nominal GDP growth and higher inflation anyway. And then finally, it would really be the very clear start of a Cold War, where that capital realignment we've already discussed would accelerate, and it wouldn't be flowing into China. So, the bad news is that the real trigger, I think, is that, and that would bring the markets down steeply. But I think that would be a wonderful buying opportunity. So we can only talk about the known unknowns. The unknown unknowns obviously will forever be beyond us. But I would flag that one up as a potential important one. But otherwise, I think. If I'm wrong in interest rates and they allow interest rates in the West to find their own level, that would be a shock. I mean, if I think inflation is going to be 4, where would the long 10-year bond yield be? And if the 10-year bond yield was at that level, we'd have absolute chaos in financial markets. Yeah. So most people who read textbooks would say, well, that has to happen if inflation's at 4, interest rates have to be at 5. I don't think it has to happen at all. But if it did happen, if I was wrong on that, and they let market rates find their own level eventually, it may take another year or so, then we'd have chaos there. But I think that's the one that frightens most people, is that interest rates reflect inflation. That would give us very high nominal rates and a crisis. But I do think that's very unlikely in the developed world.
Interesting you mentioned that. Just last couple of questions, Russell. One is on the follow-up on the point that you mentioned. There is a school of thought which says that even if rates are to move higher, albeit not 4%, but people said even if rates are to move higher, but if they happen gradually over a period of the next 12 to 18 months, which the Fed tries to prepare the markets for, then there won't be chaos all around. You second that, or you didn't, or do you differ?
Well, we can look at the history of these cycles. So, that is the actual history of a cycle. As interest rates go up and the market just ignores it until it doesn't. So that's the thing. And really, it's only when the market starts to pay attention to it that the Fed's working. We like to focus on equity markets, but you should really be then looking at spreads on corporate bonds. And when the Fed's notching those rates up, they'll be looking at the spread on corporate bonds and concluding that until the spread on corporate bonds start to widen, or until bank credit begins to slow dramatically, that actually it isn't working. So all in my opinion, is in a cycle is that if the early movements in interest rates don't work, there are going to be more. And they do increasingly work through the transmission mechanism of financial markets, the corporate bond markets, and then obviously the equity market. So you can definitely have a period where, let's say, inflation is rising faster than interest rates, and the market really kind of ignores it. But that tells you the Fed is failing. So back to the basics, I don't think that's what's going to happen. That would be your normal cycle where the Fed is always behind the ball, and then suddenly it's ahead of it, and the markets come down. That's your standard cycle. So you can make money absolutely as interest rates go up. But on this occasion, I don't think rates will go up at all, anyway, let me rephrase that. Throughout this cycle, inflation will be rising faster than interest rates, and the Fed will never get ahead of it because it can't afford the damage that comes with it. So it's going to be a new structure of the way things work. But anybody who's just looking at an old traditional cycle, you can see that would be the path, maybe a year and a half, and then the Fed panics and suddenly rates shoot up. I don't think that's what's going to happen this time.
So my final question, and somewhere again I read that how you mentioned, or I heard you speak about the importance of knowing the consensus and how it's positioned now. And of course, you've spoken at length about some of the points there. I'll just contain it in a nutshell. My question to you is that where do you think the consensus is parked right now both on absolute terms as well as trying to understand from the past history and positioning themselves. And therefore, what do you think can happen over the course of the next 12 months? Be it rates, be it the effect of the rates, and be it the West versus EMs?
That's a really great question, because I think in my entire career, I've never seen the consensus more wrong, I would argue. And there's a very good reason for that, is that nearly everybody in our industry now has been to business school. And they've been in a marketplace that, since the late 1970s, or in the case of India, since 1991, market forces are allowed to play more of a role, government forces play less of a role. And your entire background is analyzing that situation. And, our entire discussion is about how we don't live in that world anymore, at least in the developed world. But it is but if that's the skill set you have, you will insist on applying it, even though the world has moved to a very different place. And to me, that's the problem. I mean, I would say most of the stories I read in the financial press are looking at a world that used to exist, a world where central bankers were independent, a world where inflation was quiescent, a world where governments were stepping aside and markets were getting more important. And everything is still in that framework. There's a legacy of analysis which is still in that framework, and we've left it behind. And we've gone to a very different world, which is this world of financial repression. So in terms of anybody who's watching this, I would suggest to them really strongly that they read a lot about financial repression. And Carmen Reinhardt is the academic expert in that, lots of her work online, but just generally, and then begin to think, if this is genuinely the system we're moving into, all the stuff I'm talking about over here about central bankers and independence and interest rate, is any of it relevant? Because the Fed has been an entirely irrelevant institution in its history. I mean, they would say that themselves. There have been periods in history when it's been entirely irrelevant. And yet they are the top 5 stories on Bloomberg every day. Maybe not top 5, but you know what I mean. So I think that's the fundamental problem here. We're still trying to play by the old rules. And the rules have changed, and we need to re-educate ourselves. So normally I would say, the market's wrong because it thinks interest rates are doing X or inflation is doing Y. But this time I'm saying the market's wrong because it doesn't understand that we are in an entirely different structure. So if I can quote from The Wizard of Oz, we're not in Kansas anymore. But everyone's determined to pretend we're still in Kansas, and we're not. We're in a different place. So it's really on a grand scale, this shift in the relationship between markets, government, and people. And I think the potential beauty of this is that relationship in India hasn't changed very much. It really just hasn't changed very much. It's changed a little bit, but we've got really literally a revolution in the relationship between those 3 factors underway elsewhere, and maybe a small shift in India. So that's where consensus is most wrong. It's just hasn't worked out that this is a new system.
Yeah, well, it'll take some doing, maybe a bit of reading. And Russell, if you can hold that book up, viewers in India, please. Yeah,
this will definitely help with this, but also on the internet, read about financial repression and think through for yourself whether all the questions people are asking are the right questions. What I said about this book, and I also run a course in finance, is we probably don't have the right answers, but we think we can find the right questions. And so the answer to your last question is, I think people are asking the wrong questions. This book might help ask some of the right questions.
Okay, it is on Amazon, by the way, so people can click and order it. But Russell Napier, thank you so much for speaking to us today. And we look forward to have you more often on our platform.
Thank you very much.
Thank you. Pleasure was ours. And viewers, thanks for tuning into this conversation.